Hey everyone, welcome back to Research Investment. I'm Simo, your equity research analyst. So today, let's finally answer the question everyone's been afraid to really ask. Why hasn't the stock market crashed yet? And are we all mistaken? And maybe we should actually be bullish? Why does it keep climbing against all odds in defiance of history and seemingly in total disconnect from economic reality? Because once you see the truth, you won't be able to unsee it, and you'll know how to act when the next chapter finally begins. Let's dive in. The most alarming signal starts with simple math. Take Warren Buffett's favorite indicator, total market capitalization divided by US GDP. For decades, this ratio hovered close to 100%, sometimes stretching higher, but always snapping back with each big crisis. But zoom out and you'll see that today the ratio is at 216%. Let's put that in perspective. Before the dot-com bubble burst in 2000, it was 115%. Afterward, the market lost almost 2/3 of its value, and yet now with charts looking this stretched and disconnected, no crash. Not only does the market hold on, it keeps breaking records. Numbers like these should be a wake-up call, but they're only the beginning. Let's get even more granular. The S&P 500's top companies, the stocks everyone loves, the names everyone knows, have an average price-to-earnings ratio of 66. Not 20, not 30, not even 40, 66. That means people pay $66 for every $1 those companies actually earn. In normal times, that would be called insanity. If you only cared about numbers, if you had no context, you'd expect a crash tomorrow. You'd expect panic, the smart money running for the exits, just like in every historic bubble before. But it's not happening. So what's really going on under the hood? The first clue, massive divergence between optimism on Wall Street and anxiety on Main Street. Consumer confidence in the market itself is at a 30-year high, higher than the dot-com days, higher than the real estate mania. But confidence in the real-world economy is near record lows, as bleak as 2008. It's the biggest gap in modern history. People feel richer about their portfolios, poorer in their pockets. Why? Because for most people, the market's gains are theoretical, while expenses, debt, and job uncertainty are painfully real. Let's talk about income. Real personal income, income adjusted for inflation, followed a steady, predictable path from the 1960s until 2008, around 2.8% annual growth. People could trust that their standard of living would improve, that their incomes would cover tomorrow's costs. But since 2008, that promise broke down. Income growth stagnated, then lagged. People expected one trajectory, but got another. Now here's where it gets even more severe. If you compare inflation-adjusted real income since 2010, up maybe 50%, to inflation-adjusted S&P 500 returns, you get a different world. Stocks are up nearly 300%, meaning asset owners got exponentially richer while workers did not. So why hasn't the pain for most translated into a crashing market? Because government policy, borrowing, and the new reality of monetary management have short-circuited the old cycles. Here's what's actually holding everything up. The US government spends $7 trillion a year, but only collects $5 trillion in taxes. That leaves a $2 trillion hole filled year after year by new borrowing. This money doesn't vanish. It cycles through the economy as federal benefits, contracts, and transfer payments, eventually winding its way to corporate America. People spend, companies record profits, share prices rise, keeping the illusion alive. And then there's the Fed. Under Jerome Powell, the Federal Reserve went from fighting inflation with higher rates to cutting aggressively as banking stresses shook markets. Lower rates mean cheaper debt, easier money and even more incentive to pour cash into assets that chase returns like stocks, real estate, and Bitcoin. Let's pause here and talk about inflation, because this piece alone explains half the mystery. During inflation, the prices of goods and services rise, but so do corporate revenues. That means a company selling a product for $100 with a $10 profit might now sell it for $200 and make $20 profit, even if they're not selling more units. The earnings look great, but it's just inflation. Investors see growth, but it's really just the dollar losing value. This is the great earnings illusion. But inflation also distorts taxes. Companies can deduct interest expenses based on nominal amounts, even though inflation eats away at the real cost of borrowing. Depreciation is calculated at historical cost, making taxable profits look higher, increasing tax bills, and squeezing bottom lines in subtle, complex ways. It gets worse. In an inflationary world, even the most sophisticated management forecasts become less reliable. Companies delay capital spending, not because demand is weak, but because nothing feels predictable. So while the market keeps moving up underneath, risk keeps building. Let's not forget taxes, the hidden hand in every bull and bear market. In the golden age of the American middle class, corporate taxes were near 40%. Profits got recycled into public infrastructure and the common good. Since the 1980s, taxes were slashed, especially under the Trump administration's tax reform. As taxes fell, corporate profit margins soared. Shareholders won, but wage growth didn't keep up. Lower taxes let more earnings inflate the stock market, even as most people saw stagnating pay. This spiral, profits up, taxes down, wages flat, means the market keeps levitating, but fewer and fewer people participate in the gains. Now, let's bring Bitcoin into the picture. As central banks print money and devalue currency, investors are desperate for a hedge. Bitcoin, capped at 21 million coins, emerges not just as a speculative asset, but as a new kind of digital gold. Institutions are buying in, seeing it as insurance against fiat inflation and unpredictable government policies. It's a sign of just how fragile trust in money itself has become. What about wealth inequality? The top 10%, especially the top 0.1%, now control more of America's wealth than at any time since the Roaring '20s. Housing? The average home now costs almost 7 times average household income, up from a historical average of 4 times. As housing eats up budgets, there's nothing left for savings, nothing left to invest, nothing left for upward mobility. This is the engine driving frustration and social tension far beyond Wall Street. Now, let's step back and put all this in historical context. In the 1920s, wealth inequality and speculative markets led to the Great Depression. A market crash coincided with a policy shift, rising corporate taxes, which squeezed profits but reversed inequality and built the post-war middle class. In the 1980s, tax cuts fueled a decades-long boom, but sowed the seeds for rising inequality all over again. We haven't seen these extremes since then, until now. Here's the real kicker. This system can't last forever. Markets and the real economy can only diverge so far before something snaps. Historians call this the reset. It might come as a violent crash triggered by new policies, tax hikes, a shift in Fed strategy, or some unexpected global shock. Or it might be a slow grind, years of flat returns while real wages catch up, but the pressures are visible for anyone willing to look. So, as investors, what do you actually do? First, accept that the market today is being artificially propped up by government spending, monetary manipulation, and policy choices, not sustainable organic growth. That means diversification isn't optional. You need exposure to stocks, but also hard assets like gold, inflation-protected bonds, and some allocation to emerging stores of value like Bitcoin. Balance yield and safety. Stay nimble. Second, watch policy announcements. Every move Jerome Powell makes, every fiscal stimulus or tax debate in Washington is now a massive market event. Third, remember the fundamentals. Wealth creation over decades is about skillful adaptation, understanding when to play offense and when to play defense. If you're still watching, here's what I want you to remember. The stock market's record highs aren't proof of a healthy economy. They are signals that the gap between paper wealth and real prosperity has never been wider. Inflation and monetary expansion inflate earnings, but that's not real growth. Low taxes and deregulation have juiced profits, but only for the few. We're living through a transition. You can feel it everywhere, in the data, on the streets, in people's voices. Every boom ends with a bust, but every bust is a doorway to transformation. So, are you ready for the reset? Are you preparing for all scenarios, or just hoping that past performance keeps repeating forever? That's the question every real investor should ask now, not later. If you value independent analysis, real facts, and honest skepticism, subscribe to this channel and share your thoughts below. This isn't financial advice, but it is a wake-up call. No chart, no number, no bull market lasts forever, but with the right knowledge and preparation, you can survive and even thrive through all of it. Thanks for tuning in. Stay sharp, stay skeptical, and I'll see you in the next video. Good luck to you.